Welcome to DevTech Finance. In this video, we will be covering the topic Credit Control Measures by RBI. This video is a part of credit management tutorial, so I recommend you to watch all other related videos. Let's start with today's video and understand what exactly credit control is. Credit control is an important tool used by RBI as a part of its monetary policy to control the demand and supply of money in economy. So credit control is basically when RBI tries to control the money supply in the economy. Now this money supply RBI tries to control by controlling the credit which is provided by the commercial banks in the market to the public, institutions or the corporates. Thus the name is credit control. Now before understanding much in details, you need to understand the mismatch between demand and supply. The demand and supply mismatch in economy give rises to situations like inflation and recession. So when the prices are high, we call it the situation of inflation in the economy. Now that happens because you see when supply is limited and the people in the country are having more money power with them, they try to demand more. And supply is limited, the production is limited. In that case, prices are raised and inflation increases. In the similar way, when there is economic downturn, when the business production is hampered, when business activities are not taking place, productions are hampered, that situation is called recession. To control all these economic situation, RBI always try to maintain the balance between the demand and supply in the economy, so that there is not much bad effect on the economy and it run efficiently. Now, credit control is one such important tool used by RBI to maintain the balance in the economy and to control situations like inflation and recession, to deal with these situations. RBI exercises control over the credit provided by commercial banks to boost economic development with stability. So as I say, RBI exercise this credit control in order to boost economic development but with stability. Now this happens when RBI tries to control the credit which is provided by the commercial banks to the public. Credit here is nothing but the loan or advances which is provided by the banks to the public, to the corporates, to the institutions. Objectives of credit control. So first is to control inflation. We already discussed how RBI tries to control the situation of inflation or recession. It tries to control the money supply in the economy. And to control the money supply, it controls the credit which is provided by commercial bank to the public in the economy. Second, to encourage development in priority sectors. Sometimes it also controls this credit to make sure that priority sector development is done. It means the development in those sectors which are necessary for economic boosting, like the sectors of health, education, of agriculture, where there should be focus. These are the priority sectors considered, and thus there should be adequate development in order to ensure that RBI tries to control the credit by the banks. Ensure adequate level of liquidity in the market so that there is not shortage of funds. So to ensure adequate level of liquidity in market and to develop overall economy. So these are some of the basic objectives why RBI try to use this credit control as a monetary measure to control demand and supply in the economy. Now let's see what are two credit control measures. So we can divide credit control as quantitative control and qualitative control. In quantitative control, there is control over the bank rate, open market operations, and control over the reserve ratios. In qualitative control, we will see margin requirement, moral suasion, and credit rationing. Now let's move to quantitative methods of credit control. So first is bank rate. Now the bank rate is the official interest rate at which RBI rediscounts the approved bills held by commercial banks and provides fund. So whenever commercial banks are in need of fund, they go to RBI, they borrow fund from there by rediscounting the bills which they are having, and thus the RBI provides fund to the commercial bank. Now, how RBI used this bank rate as a credit control measure? Let's see. So, for controlling the credit, inflation, and money supply, RBI will increase or decrease the bank rate. Here to control the inflation and money supply, RBI will increase the bank rate, and vice versa. To control the depression, it will try to decrease the bank rate. So how does it works? Now see, if the bank rate is increased, it means the commercial banks, when they go to borrow from the RBI, they will have to pay higher rate of interest for their borrowings. What will happen then? If commercial banks are paying higher, they are left with lesser fund to provide to public, and thus the commercial banks will also raise their rate of interest. Now, due to this raise in interest rate which they grant as loans to their customers, the borrowers, which are the public, will be discouraged to borrow. And if they will be discouraged to borrow, it will affect the whole trading and business activities, which will be reduced, because the borrowers are publics, corporates, all the institutions which are in the need of fund, and they go to commercial banks. Now, if interest rate is raised, then they will be discouraged to the borrowings, and thus it will affect the business activities. It will be reduced, and reduction in business activities will reduce the money supply in economy, and this will bring down the price level. So this is just an example how the credit control measure works. So let's see, we see like there was inflation in economy. I already told that inflation happens when there is rise in price level, and this rise in price level is because the public is demanding more, they are having more buying capacity, and the supply is limited. Now, if RBI has done all these things to reduce the money supply, and if the money supply will be reduced, public will not be having much money, and thus the demand will be in control, and ultimately the price level will be in control, and thus the inflation will be in control. In the same way, if RBI decreases the bank rate, it will help in boosting up the economy by providing the money supply in the market and handling the recession situation. Okay, so let me explain you. For example, when there was recession in economy, you know that business activities are in downturn. For example, nowadays this epidemic COVID-19 is going on, which has led to recession because economic activities are not happening, and thus to control this recession, somehow RBI will try to decrease the bank rate. This decrease will encourage the borrowers to borrow more from the commercial banks, which will give a boost to the business and economic activities, and thus the money supply will increase in the market and bring the situation to the normal. So it could happen both the ways. RBI can either increase the bank rate or decrease the bank rate to control the money supply in the economy and to deal with the particular situation of inflation or recession. Second is open market operation. Now, the open market operation refers to direct sales and purchase of securities and bills in the open market by RBI. Now, this is done to control the volume of credit. By selling in the money market, the RBI tries to absorb the excess money supply with the commercial banks and financial institutions. So, in open market, when RBI sells these securities and bills, it encourages the commercial banks to buy these securities. And when commercial banks go and buy these securities presented by RBI in the open market, so what happens now? The commercial banks will having lesser of fund with them. Again, because of the lesser funds, the commercial banks will not be able to provide more to the public, as in general to the corporates, the people and the financial institutions who are there for borrowing from commercial banks, and thus it will control the money supply in the economy. So again, this is another measure which is used to increase or decrease the money supply in the economy, both way around. During inflation, the sale of security by RBI will encourage commercial banks to buy. In this process, the surplus cash with the commercial bank are reduced and they cannot lend more to the borrowers. So I already mentioned that. This will bring down the economic activities and thereby the income to control demand. And when the demand is controlled, the prices will be in control and thus the situation of inflation will be in control. Now this can be done in another way by RBI when it purchases the security in the money market. Then the commercial bank will having excess of money to lend to the borrower and thus the money supply in the economy will be boosted. It will be provided to the business activities, to the public, to encourage the economic activity. So both way round it can be done. It is just an example I am presenting in this slide of selling in the money market by RBI. Third is reserve ratios. Reduction in cash reserve ratio and statutory liquidity ratio enables commercial banks to lend more, thus boosting money supply in economic activities. Now, reserve ratios are ratios which the commercial banks it is mandatory for them to maintain with RBI. As per RBI's order, they need to maintain certain reserve and thus it limits the amount of fund which the commercial banks could lend in the market. Now, these reserve ratio, you can understand, like if these reserve ratios rates are increased, so the bank will have to now put more of their amount with the RBI, so they will be having lesser of the fund to give in the market to the public, and thus if the reserve ratios are decreased, it will happen other way around. It will provide more to the market and to the public. And thus by increasing or decreasing the reserve ratios rates, RBI tries to control the economic situation, control the money supply in the market. This is done by RBI when there is more supply and less demand in market. Increase in economic activities leads to increase in income, which results in more demand. It can be used another way to reduce money supply by increasing reserve ratio rates. So I already mentioned that reserve ratio rates can be increased or decreased to control money supply and to ensure the balance in the economic situation. Now, repo rate is another rate at which bank borrows money from RBI. Repo rate is increased to reduce money supply and decreased to boost money supply. So you see, repo rate is the rate at which bank borrows money from RBI. If this rate is increased, the bank will be charged more to borrow from RBI and thus it will be having lesser fund. It will be discouraged and will be having lesser funds to provide to the public as loan. And in the same way, it could happen like if repo rate will be decreased, it will boost the money supply. Another is reverse repo rate, which is also used as one such measure when RBI borrows from commercial banks. So these are all the tools which are being used by RBI to control money supply in the economy. Whether we talk about the reserve ratios, the open market operations, these are all the quantitative tools used by RBI. Now let's see the qualitative methods of credit control. So first is margin requirement. Banks do not lend the full amount of loan to the borrower. So if you are a borrower and you are going to bank to ask for a loan amount of say 100%, the bank will be providing you somewhere between 75 to 80% of that amount, because the rest they ask you to pay as a margin for you to be contributed by the borrower. So the rest you need to contribute as borrower from your fund, and the 75 to 80% of amount will be provided by the bank. So there is this margin requirement. Now, the RBI prescribes the percentage of margin a bank should maintain while granting loan. Now, this percentage of margin, for example, if it is 10 to 15%, this is decided by RBI that how much margin commercial banks should ask from their borrowers. So, this margin, if this margin percentage is increased, So again, this will discourage the borrower. High margin will discourage the borrower, and thus it will lower down the demand to control inflation. Same concept is working, only the tools are changing. There are various tools which are used to apply to the same concept of controlling the money supply in the economy and controlling the situation of inflation or recession. See, during depression again, margin will be reduced. Second is credit rationing. It is a method by which RBI seeks to limit the maximum amount of loan for specific category and sector. So this happens when RBI, what it does, it says, it asks the bank that they can't provide more than this limit of fund to the general public or to any specific sector, and they need to provide certain percentage of funds to any specific sector. So when RBI is defining how much banks could provide to each sector or to particular borrower, it means RBI is trying to limit the maximum amount of loan to be provided by commercial banks, and thus it is again used as a measure of credit control in the economy. Now, RBI guidelines. RBI issues oral, written statements, appeals, guidelines, warnings, etc. to the banks. So all these things just to control the credit and to maintain the balance in the economic situation. Moral suasion, it is a way of convincing the commercial banks to adhere to the policies and act in desired manner. So this is what we have learnt about priority sector lending. So RBI asks banks to provide 40% of their net advances to the priority sectors like health, education, agriculture, export, etc. So moral suasion is such a way in which RBI presents the policies and asks the commercial bank to act in this desired manner. This is in form of request will be made by which is made by RBI to banks to cooperate with its policies for the betterment of economy. So these were all the quantitative methods and qualitative methods of credit control with the same concept of controlling the money supply in the economy and to control the situations of inflation and depression in the economy, thus to maintain a balance in the economy and to boost overall economic development with stability. Thank you for watching. Do like and share my video. Subscribe to my channel DevTech Finance. Thank you all.